Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst stock. Today, we're looking at Microbot Medical.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Yeah, let's do.
We are looking at a medical technology company that is currently pre-revenue.
Okay, so right away, that's a flag for many people.
It is, but they're sitting on what a lot of analysts believe is a massive inflection point.
That sounds like a classic high-risk, high-reward situation.
That's exactly what it is.
So what is the core technology driving all this excitement, and what's the market sizing here?
The excitement centers entirely on the Liberty endovascular robotics system. It's a system designed for peripheral endovascular procedures.
So like procedures outside the heart, in the legs, that kind of thing.
Exactly. And the unique selling point, the thing that makes it special, is that it's the only FDA-cleared, single-use, remotely operated robotic system in this very specific category.
That's a lot of qualifiers. So only one that's FDA-cleared, single-use, and remote.
Right. And that's key. The initial target market is just huge. We're talking approximately 2.5 million peripheral endovascular procedures annually.
Wow.
And that's just in the U.S.
We know they're pre-revenue, but what's the commercial timeline? When does this optionality, start translating into actual numbers?
Well, the company is in that crucial transition phase right now, moving from R&D to commercialization.
They got the FDA clearance. That's the big hurdle.
That's the necessary hurdle, yes. And now they're executing what they call a limited market release, an LMR.
So they're sort of testing the waters in a few key places.
Nicely, in high-volume U.S. regions. But the significant date to watch, the one everyone is focused on, is the full commercial launch.
And that is?
That's planned for the Society of Interventional Radiology Conference, or SIR, in April 2026.
Okay, so that's the real starting gun. But we are seeing some early validation, right?
Right.
I recall seeing news about a high-profile hospital stepping up.
That's correct. And this is a huge piece of the puzzle.
Go on.
The first major adoption site is Emory University Hospital.
A big academic center. That's a good sign.
It's more than a good sign. They've established an entire endovascular robotics program centered specifically on this system.
So they're not just buying one machine, they're building a whole program around it.
Exactly. Getting anchored in a major academic center like that is an incredibly powerful reference site for broader adoption later on.
It kind of de-risks it for other hospitals. They see Emory is doing it, so it must be legit.
That's the idea.
But why would a hospital choose this over existing systems? I mean, robotics isn't new.
It's not, but the moat here is really threefold. First, it's that single-use, disposable design.
Right.
It contrasts so sharply with the incumbents that require, huge, expensive capital equipment and reusable parts.
So a lower barrier to entry for the hospital financially.
Much lower. Second, the workflow and safety advantages. It reduces clinician fatigue.
Which is a big deal.
A huge deal. And it significantly lowers radiation exposure.
Oh, that's a massive driver for adoption. Doctors do not want to be exposed to that day in and day out.
No, they don't. And third, there's the expanding global intellectual property protection in key markets.
Like where?
Like the U.S., China, Israel, and just recently, Japan.
Okay, so the future looks bright, but let's do a reality check on the financials. Right now, the company is operating with negative cash flows and recurring net losses.
Yes, which is typical for a development stage company.
But how is that sustainable?
Well, that is the core risk, but it's also where the structural opportunity is.
How so?
The current market capitalization is only around $168 million. That's underpinned entirely by the future optionality, not the current cash flow.
So the market is betting on the future, not the present.
Completely. And they have low credit risk because they rely on equity financing, not on taking out material debt.
Which means selling shares.
Right. And the structural upside, the big payoff, comes from the really attractive margin profile of that disposable design.
Ah, so once they get volume.
Exactly. Once volumes scale, those high-margin consumables can rapidly, and I mean rapidly, swing earnings into positive territory.
So analysts are basically looking past today's negative earnings and focusing purely on that 2026 commercialization trajectory.
That's the entire game.
So what kind of upside are they projecting?
Sentiment is, well, it's overwhelmingly bullish. You have multiple analyst reports issuing targets well above the current, say, 240, 250 price range.
What are those targets?
They tend to cluster between about $5.50 on the low end and $12 on the high end.
$12 from $250.
Yes. Achieving that high-end target would imply, well, a massive potential return for investors.
You're talking about.
Some estimates suggest up to 400% or even more.
Wow. Okay.
But that's all based on those embedded expectations of a meaningful revenue inflection through 2026.
Let's balance that out. That's the bull case. What's the bear case? What are the key risks that could just completely derail this thesis?
Number one is pure execution risk. Period.
It's a single product story.
It's a single product story. If that limited market release is slow, if site onboarding is difficult, or if adoption rates just don't materialize,
The whole thing falls apart.
the entire thesis fails. Number two is financing and dilution risk.
We touched on that. They need to sell stock to raise cash.
Exactly. Because cash flow is negative, the company will likely need additional capital before reaching break-even.
Which means issuing more equity.
And diluting existing shareholders, cutting the pizza into smaller slices.
And we should probably mention volatility too.
Absolutely.
As a microcap with limited institutional ownership, the share price is going to be incredibly sensitive to every little news update and just general risk-on, risk-off sentiment in the market.
That's right. However, on the risk mitigation side, the LMR phase itself is a risk management strategy.
How do you mean?
They are refining the workflow now before the big launch. They're getting feedback, fixing bugs, all of that before they scale up.
Learning on a small scale before going big.
Yes. And while dilution is a threat, successful milestones and a rising share price can actually reduce the effective cost of future capital raises.
Right. If the stock is higher, they can sell fewer shares to raise the same amount of money.
It creates a positive feedback loop.
So to sum up, this company offers an asymmetric setup.
Very much so.
You are accepting significant near-term risks, negative cash flow, and that execution uncertainty in exchange for what analysts see as multi-bagger potential.
Driven by a unique, first-in-class product in a very large surgical market.
It's certainly a name that you'd have to frame as a multi-year hold.
Absolutely. Likely 18 to 36 months to capture the value of that commercial scale-up and potential strategic interest down the line.
At the end of the day.
It's a classic case of betting on management, executing on a really strong piece of technology. If you enjoyed this analysis, please remember to subscribe to Smart Wealth with Joshua for more in-depth discussions every day.